Hey everybody, welcome to the Spartan Investment Group webinar for this month. We're doing a very popular and in high demand, how to do due diligence on a operator. And we are very honored today to have Russell Gray, financial strategist and co-host of the Real Estate Guys radio show on the call. Russell, how you doing?
Good. Thanks for having me. It's fun to be here.
Thanks. Well, my name is Ryan Gibson, and I'm the Chief Investment Officer with Spartan Investment Group. And we are a real estate development and syndication company. And we're based in Golden, Colorado. We're live today from Golden, Colorado. We are self-storage operators and also land and real estate developers. Russell, why don't you talk a little bit about yourself and a little bit about your background?
Well, not to bore anybody, I think my biggest claim to fame is I'm the co-host of the Real Estate Guys radio show. Been doing that since 2004. A few years before that, I started a mortgage company, which was brilliant at the time I did it, right up until 2008, when it turned out to be a whole lot less brilliant. Along the way, we accumulated a lot of real estate. We started a development company. We wrote a book. We did a TV show. But through all that, we managed to hold on to the Real Estate Guys radio show, and we do real estate development actually in the country of Belize. So when we're not doing the radio show, that's what we do. And along the way, we discovered the wide, wonderful world of syndication. And it really happened after 2008 when the financial crisis happened. And having been in the mortgage business at the time, and I could see that the distribution channel of money from savers through Wall Street to Main Street was broken. And there was going to be a continuing demand for capital at the Main Street level, but there wasn't really a mechanism to fulfill that. And so we said, hey, there's going to be a big opportunity in private capital and syndication. We had raised many millions of dollars and done many projects. And so we said, well, let's start teaching people how to do that. And it turned out to be great timing because then eventually the Jobs Act was passed, and that opened up the ability to advertise to accredited investors. That's when you saw the big proliferation of crowdfunding, and people began to be able to make markets for where individual investors who wanted to be passive but wanted to have the benefits of real estate could find an operator like a Spartan and Ryan Gibson to invest with and invest in. And it's really opened up, and it's still very much, in my opinion, on the front end of the wave. You've got the Opportunity Zone initiative that just came out. The new tax code has really made real estate the best tax shelter going right now. And so when you realize that those things are happening, I think there's still a big wave of capital yet to come in. And now you look at what's going on with interest rates, and as people are looking for yield in relatively conservative investments, as often happens when a stock market kind of bubbles up, investors begin to kind of come back home, if you will, to real estate because they can see superior yields, better tax advantages, better stability. You give up a lot of stability when you go for high liquidity. Real estate is less liquid, but because of that, it's also more stable. And if you're a long-term buy and hold investor, then the liquidity advantage of the stock market is not an advantage at all. It's really just a liability. So anyway, we think it's a fun time. And so we spend a lot of time out there just trying to get the word out on the show and participating in events like this. So very, very happy to be here.
Well, great. And to your point, that's a lot of the reasons why we're having this webinar, this specific topic tonight, because of the Jobs Act, because we can advertise for deals. There has been an explosion in the amount of syndications, operators, deals on the market, things that you might see in Facebook advertising, emails that you might get, offerings you might receive. How do you go through them all? How do you vet your operators? How do you vet your deals? So this webinar is really just about educating our investors on how to evaluate an operator for any deal that you might be doing, because as you'll see through this presentation, it's often about the team and maybe not the project. And that's what we're going to go ahead and dive into tonight. So just on the admin side of things, everybody will have a chance to ask live questions. Please write them down. You can ask them in the chat window as we go along. We just won't get to them until the end. So we have about, we'll leave some time for Q&A, maybe 15, 20 minutes at the end for Q&A. And we'll go ahead and jump into the presentation. So On all of our presentations, we like to give this disclaimer. We're not offering advice. Please seek outside counsel. We're just giving a general overview, and information contained within is subject to change. And lastly, as always, perform your own due diligence. So, and just one more admin thing, we do have a YouTube channel that we post all of our content on. If you just Google our YouTube Spartan Investment Group, you can see all of our previous webinars. We had Mauricio Raoul on a couple of different webinars. He talked about the importance of going through the operating agreements, which are critical in investing in syndication. We'll touch on that tonight. Private placement memorandums. We did a deep dive with tax strategist and attorney Clint Coons from Anderson Advisors. We did a deep dive into self-directed retirement accounts. We interviewed a CEO of a self-directed retirement account company, Joe DiDomenico. We talked about how to set up an IRA and things like that. And we also tonight are talking about where the arrow is pointing, how to complete due diligence on a sponsor. To round out 2019, we're going to have a guest talking about understanding your capital account into syndication. And we're also going to go over a K1, how that impacts your tax returns, when you should expect them, how to read them, and how to talk to an operator about, how your K1 might look if the projected returns are hit. So to kick off the webinar, we're really, I think, and Russ will get into this tonight, we're really talking about managing risk. And Sam Zell, I think, is one of my favorite real estate entrepreneurs when it comes to talking about risk. So I really love this quote. And I know, Russ, you probably had a chance to, I think you interviewed Sam Zell.
We haven't interviewed Sam yet. He's on our list, but your quote comes from his book, Am I Being Too Subtle? And I use this quote all the time because, what Sam talks about is everybody sees the opportunity. The biggest challenge you have with any investment is only seeing sunshine and forgetting to pack an umbrella. Things can and often do go wrong, and that's not a big deal if you've anticipated it and you have an alternative, you have a plan, you have people on the bus who are experienced in navigating not just smooth seas, but stormy seas. And when you can be honest about assessing the risk and then put together a plan to navigate it and end up on the back end with a profitable deal, that's a big part of it. That's why, taking a look at who the operator is, and I'm sure that, Ryan, we're going to be touching on that tonight. It's really important because you're betting to a degree on the jockey, to mix metaphors if I can.
Yeah, absolutely. And, and I think no matter what we do, we're all taking a risk. So we have to understand that, and we'll get into a little bit about that. But if the operator tells you it's risk-free or there's no risk, then there can't be any reward. So we want to make sure that our operator is on the same page and not just trying to sell us something, and really understands the risk in the deal, and most importantly, you understand the risk. So what we're trying to avoid is Fire Festival 2020, where there's an expectation of sandy beaches, blue oceans, nice yachts, and we end up with tents and trash and not a very good festival, which was turned into a great Netflix documentary. But this is what we're trying to avoid with operators. This is just a little bit of my background in aviation. We in aviation talk about risk mitigation strategies using the Swiss cheese model, where if all the holes in the Swiss cheese line up and you continually make errors upon errors upon errors upon errors, essentially you have an accident. And in aviation, there's never one thing that causes an accident. And it's no different than in deals. The Swiss cheese model we have here, we talk about, an operator making a promise, a lack of a business plan, them saying something like, this is a once in a lifetime opportunity, run to the back of the room, or miss this opportunity forever, or maybe they don't have any track record. So Russ, what are some other things that, are maybe expanding upon what we have on here that might be some red flags to you?
Well, I mean, obviously you're looking for people who are experienced, and yet everybody has to start someplace. And sometimes somebody who is relatively new in the business can compensate for their lack of experience with their hustle and building a solid team. So to me, one of the big questions is, Tell me a little bit about your background, but what I'm really interested in is who supports you and how. So I'm looking at the advisory board. I'm looking at the people on the team or the people that are going to be contracted to do the tactical work. Ultimately a sponsor or an organizer or a syndicator, whatever you want to call it, the person who's putting the deal together, their expertise has to be in putting the deal together. It's less about having to be expert at every nuance of the individual project because they've got technical people to do that. So you're not just investing in an individual, but you're investing in a team, and you're trusting that individual who's the quarterback, the captain, the head coach, whatever description you want to use, to run a good play and to hold the players accountable, and then to provide great communication to you as far as what's going on, good, bad, or ugly, so that you know where you're at, you know what's coming, and then over time you will begin to develop trust, not just based on presentation. Hey, this is who I am, this is what I hope to do, but when they have a track record with you yourself, and you begin to get that. So don't ever put all of your eggs in any one operator's hands. It's just you test the waters with a little bit, let them prove themselves, and then when they do a good job, you can bring a little bit more to the table. I think it's always wise to do that.
Absolutely. So, and one thing that we wanted to kind of get out tonight is the basic research. So as Russ was saying, when you look at a team, ask the operator, well, who's on your team? And who is operating the property, who's doing your property management, who's doing your accounting, bookkeeping, maybe who did your underwriting, who's guaranteeing the loan. Just some basic questions. And, we have a list of things here that Russ was going to touch on, for doing just your basic research on the team, because I think that should start happening. If you're going to pick a jockey or pick an operator to go with, you should start looking to research that team maybe before they even present you with an opportunity.
Yeah, we say all the time, first of all, it starts as an investor. You have to kind of know what you're looking for. We call it your personal investment philosophy. What am I trying to accomplish? I'm going to put this money out there to work in the marketplace. What is it I want it to do for me? The more clear you are on that as an investor, whether it's cash flow, capital gains, preservation of capital, tax breaks, asset protection, estate planning. There are lots of things that an investment can do for you in your portfolio. And a lot of times it can do more than one thing. But if you're not clear about what it is you want, and then you look at an investment, it might be a great investment for somebody else, but it might not be a great investment for you because it doesn't get done what you want to get done. So that's number one. Then when we talk about markets, to us, there's three types of markets. There is the geographic market, because a lot of times, and especially with real estate is very driven by local market factors. It's interesting what's happening geopolitically and all around the globe. It's interesting what's happening national and what the averages are. But ultimately, when it comes down to a specific project, it's going to be about what's going on in that neighborhood, in that particular market. Whether it's commercial or residential, whether it's new build and you're looking at supply and demand dynamics, or it's a rehab, or whatever the kind of project is. In Ryan's case, it's there's a lot of self-storage involved, and there's a certain type of demographic, and that has to be present. So the market is the geography. It's also the demographics. Who is the customer that this particular property is designed to serve? If it's a residential assisted living facility, they're older folks. If it's a startup housing, student housing, that's a different demographic. It could be industrial, distribution, could be farm. You're going to find all kinds of different things in any different market in terms of the product niche. And so you're going to look at the demographics, you're going to look at the geographics, and then you're going to look at the niche itself. And what is the product type, and does the product type fit the market, and does it fit the demographics? So those are some of the questions, and you look at that and say, does that match me? Does the game plan for this particular property or project and what they're targeting as a financial result, does it make sense based on the market factors? And the good news is almost everybody's intelligent enough, given the information, to make a pretty good judgment. Does this make sense or not? This isn't like it's bioscience or something complicated. And then the second thing is does it make sense for me? Is this what I want my money to do for me? What this thing is likely to do? And then you're looking for a match. And a good operator is going to be helping you determine whether their offering is a good match for you, rather than trying to push a square peg into a round hole.
That's a really good point, because not every offering matches with the investor. And we've actually told investors that, hey, I know that you're looking for good equity build and this is not the one, or we've told them that this is a ground up development and there's no cash flow and you're expecting cash flow, and I know that that's the type of investor you are, so this might not be the one for you, but hey, there's another deal coming in the future that better suited for your criteria. And to your point, Russ, and at the How to Win Funds and Influence People conference, one big takeaway I took away from the sales training is when I have an investor consultation, I ask them what they're looking for, what my investors want, as the first question in our kind of consultation, so that I can annotate what their investment is doing. So when the deal actually comes out, I know that it's matching their style or not. And I'll let them know if it's, hey, I don't think this one's very good for you.
Yeah, and you know what, Ryan, let me just interject. That's a great point, because if you're there and you're talking to anybody offering you anything, and they're pitching you on their deal and why their deal is great, and they never ask you who you are or what you're looking for or what would be a win for you, then you're talking to somebody that's self-centered and not win-win or you-centered. And to me, that's a little bit of a litmus test on the front end of a relationship. Are you about me or are you about you? And it's okay. We can be about us. It can be win-win. But if you're 100% about you and there's no room for me, then that's probably not going to be a good marriage, especially when the other person is in the driver's seat and you're not, because you're passive.
And I'll say from experience, there's always another opportunity. There's always another investment. This is never the last time we're going to have an offering. It's not a once in a lifetime opportunity ever. There's always going to be more, right? And investors know that, because there's lots of different operators. There's lots of different people to invest with. So if you're getting that pressure and they're not really listening to what you want, I think that's a great point. It's might not be a good fit. So let's talk about just kind of the equity and debt. I have this slide kind of as a theme through all of our webinar education, but just understand the deal and understand how you are fitting into the project. Are you a lender or are you an equity investor? And or maybe a mix of both, maybe a convertible note or something different, but make sure you understand where money's coming from or how you're getting paid. Do you have anything to add to that in particular, Russ?
Well, I mean, when you enter into any type of a deal, there is an exchange of value, or there should be. In other words, you're going to take on risk in exchange for reward. And what you have to look at is your risk adjusted return. The more risk you're taking, the more reward you should expect. And so most of the time, a thoughtful operator is going to put together a deal that reflects that. Equity gives you a better pop on the upside because you get to participate. It's like stocks. When you buy stocks, hey, stocks can go way up. Problem is stocks can go way down. When you buy a house, if you own it and it goes up in value, that equity is yours. And if it goes down in value, your equity disappears. With debt, you're in front of the equity, which means, like with your loan on your house, for example, if the house goes way up in value, as a lender, you don't really participate in that. But if it goes way down in value, you don't take a haircut either. The only danger that you have is the person defaults and gives you back the property, and that's part of the risk that you accept. There's one other thing that's not on here, and sometimes it comes up, is sometimes you can be a credit partner. Sometimes when there's a loan involved and a sponsor is putting a deal together and they need financing, sometimes they need a guarantor or a collection of guarantors or a balance sheet that can underwrite a part of the loan. And you don't actually have to put any real money in, but you are taking some risk if the deal fails. And so you never probably would want to guarantee the whole thing, but that's not on here. But you can be equity, you can be debt, or you could be a credit partner.
I'm
And
so glad you brought that up
these are the
because,
three ways to participate.
yeah, no, that's a really good point. I'm really glad you brought that up because that brings up a whole nother risk. I mean, if you're signing on the loan, you got to make sure maybe you understand your credit partners or the other people that are on a loan and their credit worthiness and liquidity and other things like that. So it's really, really key. Let's talk about required paperwork.
Well, hey,
Oh,
Ryan, let's just step back. One other thing on that is just understanding. I mean, just no investor left behind. Normally, these things are going to be put together in either what's called a general partnership, where you have a general partner and limited partners, or a limited liability company, which is a hybrid of a corporation and a general partnership, where you have a managing member or a manager, and you have limited members. And the point of being limited, whether you're a limited partner or a limited member in an LLC, is your liability is limited to only the capital that you put in. There's a veil. You're not responsible for the loans unless you sign specifically on that. You're not responsible for the liabilities of the project or the debts of the project or any of that. So part of what you're doing is saying, hey, I'm going to put my money in, but I'm going to be insulated. The burden, the responsibility is going to fall on the sponsor. Sometimes you get in a deal where it behooves you for whatever reason, maybe a little extra, or because if you're going to be a guarantor, the lender needs you to be a principal, or there's some other reasons why. Sometimes you're going to be on the active side. So just understand when you're looking at a deal structure, you want to understand, am I active or am I passive? Am I a limited liability member, or do I have greater responsibility than just the capital invested? And your sponsor and your attorney and their attorney should be able to explain that to you in very clear terms.
great. And speaking of being active or passive, if you're passive and you're not seeing the documents that I've got listed on the screen, I would think about running the other way. When you're looking at a deal, while not required, a private placement memorandum is a great idea to receive as a passive operator. It's going to list all of your risks and, purchaser questionnaire, subscription agreement, business plan, operating agreement, all these things are what really, the operating agreement, it's setting the rules for the business. That's great. You got this fancy offering memorandum that promises all, or projects all these great things and says you're going to get this and that or whatever. But really, the operating agreement is the boring black and white dry document that really tells you what you get and sets the rules of the organization. So, have your financial and legal team review the operating agreement. And Mauricio had, I think, a major nugget. And he said when he used to do consultations for people passively considering doing a syndication, he would say, explain to me what you think this deal is doing for you, and then I'll tell you if the operating agreement says what the what says what actually what your expectation is.
Sounds like we have another presenter. So let me just chime in, Ryan, if I can, real quick. Again, I'm always cognizant of people who are looking at something like this for the very first time, and so I just want to shoot through real quick. When you think of an operating agreement, that's like your corporate bylaws or the constitution of the deal. It outlines roles and responsibilities. It tells you what your rights are, what the expectations are, what the responsibilities of the manager are, and how decisions get made, how profits get distributed. So it should never be a handshake deal. It's all spelled out in the operating agreement. The business plan is really just the game plan that the person running the project is aiming at executing to produce the results. And so it's not really a legal document as much as it is just a representation of what they intend to do. The private placement memorandum is something that is designed to fulfill a specific securities requirement. And sometimes it's required and sometimes it's not. I won't get into when it is and when it isn't, but it's always nice to get because it outlines in very clear terms what all the risks are. If you ever listen to a TV commercial for a pharmaceutical or any type of thing where they have the disclaimer at the end and they tell you that all the horrible things that could happen, every single thing that you could possibly imagine could ever go wrong ever, that's all listed in the private placement memorandum. The idea is that you're supposed to be able to go in with all the material facts, with a clear understanding of all the risks to the best of the sponsor's knowledge, so you really can make a grown-up decision about this. You may say, hey, yeah, an asteroid could hit the Earth, and maybe we could have, like a new ice age. What are the odds of that? Probably not good, but it could happen. It would blow the deal up. I mean, that's an extreme example, but you get the point. There's going to be some stuff in there that the probabilities are very, very low, but you do need to be aware. Sometimes there's risks that you don't even contemplate because you're not knowledgeable about the niche, but they should be represented in there. Don't get too afraid when you see it. Understand there can be some alarming stuff in there, and then you just have to ask yourself, how probable is this likely to happen? The questionnaire.
Can I say one thing on the PPM?
Yeah, sure.
So if you have a legal team reviewing your offering, and you absolutely should, especially when it's the first time doing a deal with an operator, I think you should have an attorney review these documents and make sure that, and I love it when attorneys review these documents from an outside, because I always learn something. It's kind of like free advice, and it makes us better. But just be aware of the type of attorney you're having doing it, because if you have an attorney that is not a syndication attorney, is unfamiliar with private placement memorandums or private placement investments, chances are they're just going to tell you don't do the deal, no matter what. So make sure that attorney is experienced in this, so they can say, hey, instead of it saying that, it really should say this. And this is what this means, and this is what you need to be aware of. I think.
Yeah, let me chime in because I have a lot of energy on this particular one. Okay, so attorney, your attorney works for you. And, one of the things I like to tell the attorneys, look, I'm looking for a reason to say yes. And I'm looking for you to make sure that when I make a business decision, that I have all the material facts. I'm not asking you to give me business advice. I'm asking you to give me legal advice. So your attorney shouldn't be telling you you should or shouldn't do the deal. He or she should be explaining to you what the risks are from their perspective, and then you need to make a business decision if you're willing to accept the risk in exchange for the potential reward. Again, attorneys, their job is to keep you out of trouble. Their job is not to make you money. And if you end up suffering a loss and you decide to sue them, then they missed something, then so their E&O kicks in, and so some attorneys will be a little bit protective of themselves, and under the guise of being protective of you. So again, you can't make any money not doing deals. So you want to make sure that you let your attorney know, hey, I want to do deals, and I want you to help me understand the risks of doing a deal so I can make the business decision. Doesn't mean I don't want your advice or your opinion, but separate your legal advice from your business advice. And you just have to understand those are two different things. Let me just jump down real quick on the other two things. A purchaser questionnaire is often just about making sure that they understand the basics about you, your financial wherewithal, your sophistication, so that they can help you make a decision about whether or not this is suitable for you. Most of the time, these guys don't have a fiduciary responsibility in the same way that a financial advisor would. They're not financial planners or financial advisors, but they do have to make sure that they understand who they're doing business with, and that you're qualified as an accredited investor in most cases. Or if you're not, then for sure that there's certain disclosures that have to be present when you're non-accredited, or sometimes you're going to be excluded from deals if you're non-accredited. So they just have to know a little bit about you. They're not trying to be nosy. They're not fishing for more opportunity. They're just trying to be compliant with the law. And then the last one, after you've gotten through all that, is a subscription agreement, where it's kind of your order. So it's where you sign up. You sign in and say, yes, I want in, and then you've agreed to subscribe, if you will, to the offering. So that's what each of those documents are. You'll see them in most of your packages, and after you've done it a few times, you get pretty familiar with them. They're not all that scary. Buying a house is probably worse.
Absolutely. Good discussion. We've shown this slide before, but just kind of, and this is moving slowly. There it goes. Just kind of talking about when you're looking at an opportunity, or a team is presenting you with something, core plus, value add, opportunistic. understand the return that's coming from each risk, because remember, you're the one signing up for the risk, so you should be signing up for the appropriate reward. And when we put together projects, let's go all the way down to, we're primarily targeting value add and opportunistic. So opportunistic being a raw land development deal that is risky. You've got a lot of risk, permits, plans, timelines, a lot of external agency approvals versus value add, which may be already existing and you're just adding on to it. So the risk goes down a little bit. So does the return, maybe the profit that comes out of the business. Anything to add, Russ?
Yeah, I mean, everybody kind of has their own terminology. I'm just going to kind of lay it out in a way that I hope for some of you just keeps it super simple. The more unknowns, the more variables there are, the more things could go wrong. So if you're building something that's never been there before and in a marketplace, then you have no idea if the market's going to absorb it. You have no idea if it's going to come in on time, on budget, if there's going to be permitting issues. There's a lot of unknowns. Of course, if you conquer all of those, there's a lot more reward. Whereas if you go buy something that's already mature, it's already operating, it's already absorbed in the marketplace, it's producing predictable cash flow with a great track record, that's a pretty low risk deal. And of course, because of that, you're probably going to pay a higher price to buy it, but you're buying the stability and the security. And so just understand that the basic premise is when you're looking at any deal, there's going to be a lot of components of uncertainty, things that the operator is going to have to do. A percentage of those things are going to be within their control, and a percentage of those things are going to be outside of their control. And so when you're looking at the deal, you have to ask yourself, do I feel comfortable in understanding the things that are within the operator's control? And do I feel comfortable with their ability, their team's ability in terms of their competency to be able to control those things and produce favorable outcomes? On the other side of it, you need to look at the environment you're in, whether it's an interest rate environment, an economic environment, whatever it is, and ask yourself the things that are outside the operator's control. What do I understand about that? What does he understand about that or she understand about that? And how do I perceive those risks? And again, the concept is the more uncertainty in the deal, the more variables, then the more risk, and therefore you should expect to have a little bit more reward.
And also this isn't always the case, but maybe if the operator has a lot of experience, you might see more, it might mean that it's more of an assurance that you might get that return. Maybe not. It doesn't always mean that. And maybe an operator that has less experience, maybe you might want to see a little bit more meat on the bone in the deal, or maybe a little bit more of a return. Just something, just kind of, some thoughts. So talking about the value that the operator is bringing to the team, kind of a nice transition to that. Are they, what type of experience are they bringing? Is it a value add opportunity? Did they find it off market? Equity at purchase, strong team. My personal opinion that a syndicator, the value a syndicator or an operator brings to the market is they're looking at hundreds, if not thousands of deals, and they're presenting you with the one deal that they've decided to move forward with. And typically when they bring that deal forward to you, they've already done a significant amount of feasibility and due diligence, and they've understood the market. So by the time that gets presented to you, all these things are sort of been vetted, and you're sort of seeing, the very large funneling of deals to get you to this point. So I don't know if you had anything to add to that.
Yeah, I mean, I always have something to say, right? You put a microphone in front of my face and I'll go. I've been doing radio forever. So I have a soft spot in my heart for people who are just getting started. So I look at it like this. If you were to go to a hospital to get like brain surgery or heart surgery, some really important thing, life or death stakes, and the hospital's brand new, are you nervous? Maybe. But if the hospital administrator, and it's a brand new hospital, has a surgeon with 20 years experience and a proven team, all of a sudden you can be doing business with a company that's fairly new, but they're bringing a lot of experience through the team. So just make sure that, when you're looking, look at the totality. I mentioned it before, but I'm repeating it because I think it really bears repeating. Make sure you look at the experience. And of course, if you're watching this and you're the person putting the deal together, be attentive. Sometimes it's worth paying a little bit extra to have the right people on the bus that are going to show well to your prospective investors. Ultimately, you have to trust the folks who are going to be running the project in terms of their ethics. You have to trust them in terms of their competency. You have to trust them in terms of their commitment to you. As we mentioned earlier, is it all about them, or are they concerned about you? And then the other thing is their capacity. If they have too many deals going, too many irons in the fire, they might have the other three, but they just don't have time. So you want to evaluate them against those 4 C's, and the size of the team, the experience of the team, and really how many different other things they're involved in, what they're doing, and how much attention are they going to give, all factor in. And to one other point that I just want to emphasize that Ryan brought up, which is a great one, is it's not just the deal at hand that you're investing in. You're investing in a relationship with somebody that can be a source of deal flow. And if they're out there turning over rocks, if they're out there building bridges of relationship, if they're out there climbing up the competitive ladder to be high up, first in line or second in line or whatever for some of the better deals in the marketplace, the cost of getting there is built into the cost of doing business. It's like drug companies, there's a lot of money in R&D. Yeah, now that they got the secret formula, anybody can crank out the pill for a few bucks, but there might be millions of dollars of R&D to figure out what that formula is. And if the people who do that work aren't rewarded for doing that work, that R&D doesn't happen. And so just remember that this is a partnership. At least that's the way I view life. And you're making an investment in an operator. You're not begrudging them making a profit. You're actually investing in them, helping them be profitable so they can go continue to do more and better deals and bring you more and better deals. And then on the flip side of it, as an investor, you want to make sure that you're not the last person to get the phone call when they've got the hot deal. You want to make sure that you're the first person to get the phone. It's like Uber, right? When you go to Uber, you're rating the driver, but the driver's rating you too. And so if you find yourself standing at the corner, like 10 minutes and nobody will pick you up, you might have like a 1-star review. So, I make sure whenever I use rideshare, I tip well. I make sure that I take care of the driver because I want every driver who's out there, when I want a ride, to hit yes, I want to give that guy a ride because I want to get picked up fast. Does that make sense? Just understand this is a relationship business, and your interest in seeing other people become successful actually will bring back more success and more opportunities for you too.
That's probably one of my most favorite things about Main Street investors investing in Main Street deals and investments is just the heart that goes into that. And I'm probably stealing one of your quotes there, Russ.
Yeah,
Uh,
well, that's the
I mean,
mission.
Main Street investing is all about the heart, and you're part of the success of a small business and a small operator, or maybe a mid-sized operator. But you're actually kind of rewarding the operator for looking at thousands of those deals, all the airline travel, the flights, the frustration, the negotiation that goes on for months on a project that ends up failing. That's the part that you're not seeing. You're seeing the deal that actually has the opportunity to work and the relationships that are forged along the way to get to that point. So great discussion. So moving on to, and just we're kind of looking at the inside of one of our offering memorandums that we send out to investors, and how we do, and just kind of a little bit of background. We talk about a project overview, an executive summary, projected returns. We talk about the feasibility and the demand in the market, a competitive analysis, what operational improvements, marketing improvements we're doing to the property, any expansion. We wrap it up with some financial sensitivity analysis, and then next steps. So we're kind of going through, when I say questions to ask, kind of things to look for in the offering memorandum. So Russ, let's talk about the competition. And I know we in preparing for this, we talked about this and talking about differentiating from the competition. We may or may not need to, but for a particular investor, they may look at just the competitive landscape in the market.
Yeah. So, I mean, I don't always necessarily, I don't go into the marketplace looking at things being competitive. You and I talked about that kind of in the prep for this, because everybody is out there, or should be, interested in helping the investor succeed. And so everybody's offering may have a different nuance or a different thing that it does. And what you're looking for is a match. So it's really important that you just understand what it is. And we talked about this earlier, who you are, what you're looking for from an investment, but also what you're looking for in the relationship. Because if you don't look at the person who's bringing you the offering as a vendor, but you look at them as a teammate or an employee that you're going to hire to go out and find you deals and run your projects, put your capital to work and make you a profit, you treat them differently. And so part of the thing that can differentiate somebody is just how well do you get along with them? Do you enjoy spending time with them? Do you like getting together and looking at the kind of deals that they're doing? The second thing is, all things being equal, when you go out in the marketplace, are there other people doing similar things? And how does the guy or gal that you're talking to compare? But ultimately, when you're looking at the deal, because you have to understand where the profit comes from. The profit doesn't come from the operator. Profit doesn't come from, the property. The profit always comes from whoever the end customer is, whether it's the person who's renting storage space in the self-storage unit, or the person who is renting office space in the office building, or retail space in the shopping mall, or whatever it is. Ultimately, it's going to come down to supply, demand, capacity to pay. And when that guy or gal or that business is looking at deciding who they're going to do business with at the point of sale, how does what you're offering compare? And does the person who's going into, say, a crowded marketplace have a game plan to stand out, to win more often than not the competitive analysis? If you have somebody who can only compete on price, it's hard to make a profit. Generally, we like to see somebody who has got a better story to tell, that has found a way to meet the needs of a marketplace. Give you Starbucks, for example. Starbucks doesn't compete on price. Nobody goes to Starbucks looking for a cheap cup of coffee. Starbucks changed the rules of coffee. They changed the entire industry. And so that is a unique selling proposition, and they have garnered huge profits as a result of it. And investors who invested with them made money. If you would have evaluated that deal, so, well, nobody's going to pay $4 for a cup of coffee, that's not competitive. Well, then you were judging it on the wrong criteria. And so a good operator, a good marketer, somebody who understands their product niche is going to be able to explain to you, here's how we are going to compete in a marketplace and garner the profits that's going to make us all money. And if that makes sense to you, and most of the time it should, because again, this isn't rocket science, it's very simple. If that makes sense to you, then that's something you can believe in. Then I'd say that, you're probably, on the right track. We used to go out, Robert Helms, my partner, and I, in the early days, we would do some apartment investing, and we would literally go out and pose as tenants, and we would go around and we would apply or look at different units and we wanted to know how were we greeted, what was the collateral like, what was the whole sales funnel of being shown the property, the follow-up, the whole bit, asking ourselves, how can we create a better experience without just dropping the price? How can we add more value? And so I think you've got that on here somewhere in there, but the value add component is not just in fixing up a property, but it is enhancing the customer experience so that whatever you're doing at the ultimate source, the point of sale, where the money is coming from, that's going to make everybody rich, how is the offering going to compete without giving itself away?
Yeah, and sometimes you can even, as the passive investor, time permitting, go to the market, ask for a tour of the property, and really the operator should be showing you the area and not just the property, and how our property differentiates against others. Or, it could be the second best property, the third best property, so we could show how the other demands of the property compare to ours, and how we've mystery shopped or gone to each property. I'll say that that's what we do too. We actually go to every single competitor in the market before we buy a property to make sure we've done our feasibility and our on the ground due diligence to see how our product compares to the marketplace.
And sometimes you don't have to lower the price. Sometimes
Yep.
your competitive advantage is operational. You know, you can say every competitor in the marketplace is using antiquated software or no software at all. We can come in with automation or better training, and we can match the price, but provide a better customer experience and bring the operating costs way down. So you don't necessarily have to have high pricing or somebody that's got a game plan for charging a premium, but you do have to have a game plan for how are they going to create a spread between revenue and expenses and create a net operating profit.
Absolutely. So talking about the next thing, a great question that I think you should ask an operator or ask yourself or just kind of think about in your checklist. What have you done in the past that makes me want to bet on you? And then a kind of a follow on is who on the team has specific asset class experience? So is this the first time they're ever buying a self-storage facility? And I'll tell you from personal experience, we bought an RV park for the first time, and nobody on our team had RV park experience. However, our operations director had experience running hotel chains. So the hotel industry is very comparable to the RV park industry. So just because maybe they hadn't been in that asset class, you just need to understand how that operator might be, how you want to hear the answer from them. Ask them the answer. No one on your team has experience in this asset class. Or ask them, do you have any experience in this asset class? And then if they say, well, no, we don't, the follow on from the operator should be, but here's how we're going to operate, and here's why it's going to be successful. And that's sometimes it's always just in the answer, not necessarily in the exact experience. It's what their plan is to take over. So like as Russ mentioned earlier, taking a bet on a new operator is not necessarily a bad thing, but there just has to be a little bit more planning perhaps, or just a little bit more strategy behind what they're setting out to do, and not just a lackadaisical, oh, it's going to work out great, everything's going to be fine. There's kind of got to be some processes and procedures there. So one thing we do is we always send out a portfolio of projects, and that gives the investor the opportunity to see everything that we've got under management, under development, and what we've completed in the past, and a little bit about our team and bios and things like that.
I think a great question to ask, Ryan, is to ask someone to explain to you as the investor, or it should actually be in some of the documentation, but if you're in this one-on-one conversation, how do the skills and experiences of the team enhance the opportunities for success in this particular project? Because that gives them the opportunity to say, hey, our person has all these years in the, what did you say? You bought an RV park, but they had in the resort, whatever.
Hotels.
Hotel. So they had hotel experience. So they were used to nightly rentals, and so they were used to the operational components of that, and customer service and turns and all the things that go on in that particular business. And then they are able to bring a paradigm or a fresh approach to a business that has, the basic components, but they have a plan and how I'm going to leverage that. If they can't answer that question, if they don't really know how their team's skill and experiences translate into optimizing the potential for success in the deal at hand, then that's kind of a red flag for me, or at least a yellow flag. It's like, you should know that. But if somebody says, hey, this is why this is a great situation, well, then maybe that makes sense. Because sometimes people can come in and they can't think outside the box. Somebody says, well, I got 20 years experience, we've always done it this way. Well, then you're not going to change the rules of the game. If the Howard Schultz or whoever founded Starbucks would have said, hey, we're going to go get the guy that's been running the 5-cent coffee shop down on the corner, and that's going to be our chief, R&D officer, that person's not bringing anything new to the table. So, but the key is are you looking to change the rules, or are you just, you got a bunch of people who happen to be available and we're just going to go try this new thing? So this is where it's a lot more art than science in doing the due diligence. You know, you have to trust your gut. Does this person seem confident? Do they have a game plan that makes sense? Do the people they have, do they have a way they're going to leverage their skills and their experiences into the task at hand? And does that make sense to me? If it does, great. If it doesn't, poke holes in it and see. Maybe they'll say, hey, you know what? You're right. We're going to go hire somebody that's the world's best, whoever, to do this project and consult with us on this. And if we do that, then is there any reason you wouldn't want to move forward? That type of thing.
Absolutely. No, that's just a ton of great points. I mean, especially the Starbucks and competing on price. I really like that as a great example. So we'll talk about the business plan. You know, the business plan is essentially, it doesn't have to be anything, I don't think, too expansive, but just an understanding of how they're going to do project management, property management, how they're going to add the value to the park or the facility or to the apartment building. And then, you know, a little bit of, hey, what type of plans have you done in the past? Anything else they should ask when it comes to the business plan, Russ?
Well, you know, I think a lot of you who are watching this as investors may have experience in management or projects or whatever. Even somebody, we have a lot of doctors, you know, that invest, and I like to use medical analogies a lot because they can relate to it. But you know, when you're looking at a value add project, you're buying a set of problems, and the key is, can we solve those problems? So the projects have phases, you know, so every project is going to have an entrance, it's going to have a hold, and it's going to have an exit. And I think we're going to talk about that momentarily. Sometimes in the acquisition, in between the acquisition and during the period of hold, the hold period comprises of triage, which is stopping the bleeding, fixing the problem, and then what I call rehab, which is kind of getting the basic structures in place, the people on the team, whatever the bones, if it's whatever the bones of the project is, you know, maybe if you're building something, it's got to get built, but you're not done yet because you got to lease it up, you got to stabilize that income. And then a lot of times, especially if there's a cash out refinance or a sale on the back end, you're going to be working on leveraging that stability, that track record you built in the product. So the amount of work that needs to be done should have a logical sequence. They should be able to tell you, here's where we're going to start, here's what we're going to do, here's how long it's going to take, here's how much it's going to cost, here's what that looks like in the open market, and so here's how we're going to get in, here's what we're going to hold, here's how we're going to get out, and this is where you get paid along the way. That's what you're looking for in a plan. When you see the plan, then you look at the plan and you look at the team and say, does this team look like they can do these things? And if you say, yeah, it looks like they can, then that is probably a good bet. If somebody says, hey, we're going to get into this thing, we're going to make it up as we go along, we're going to figure it out, and you know, hey, it's a hot commodity or it's a hot sector, and you know, maybe if we just stumble around in the dark long enough, we'll bounce into a profit. Go the other way, run, because that's not a plan. Hope is not a strategy.
Exactly. And I think the other thing with the plan is, do the numbers in the pro forma P&L, do they match what's been written for the plan? You know, a great example is when we expand a facility, you know, maybe we buy an existing facility, cash flow happens day one, and when you expand the facility, the debt load goes up on the property, and we have a ton of vacant units as soon as they're built. So you should see the financial modeling go down while we lease up those additional storage units for a period of time. Just a very small example. Just start thinking through, okay, this operator wants to buy a 300 unit apartment. They're going to take 50 units offline. It's going to take them, you know, 5 months to complete the renovation or however long. I should see that reflected in the business plan and the financials, to have a dip in the cash flow. And then I've got to see in their operating reserves that they're carrying enough capital to cover those losses or that blip in downtime long enough to make it back through the lease up of those units when they bring them eventually back online. And I also want to see their lease up rate assumptions. Are they running the pro forma on a 30 unit lease up per month for a brand new storage facility, or they've conservatively estimated at 10 to 15 units per month? And what is the market doing in storage? Prices are actually going down a little bit. More inventory is being added to the market. So are they being realistic with what the marketplace is doing today? Just because it's, they've had 5% or 3% rent growth assumptions for the past decade, it doesn't mean that going forward it's going to do that. So just a lot of little gotchas to look for in the underwriting that ultimately drive your return.
Yeah, I think, and that's a really good point because, the bane of every small business is undercapitalization, over optimistic assumptions. And so when someone has something in their business plan, in their financials with assumptions, because it's all based on assumptions, nobody knows what's going to happen in the real world. One of the key questions is what is the assumption based on? And somebody who's done their homework should be able to refer to a study or a market analysis or industry standards or something. In other words, it's not just a number I pulled out of my hat to make the spreadsheet balance. And then once that gives you, as a layperson who maybe doesn't have a ton of experience in the space, saying, okay, at least this number isn't something that somebody just made up. It's based on some semblance of real world. Maybe it's even something you could go take a look at or evaluate if you wanted to validate that the assumption is rooted in reality. And then once you have that, then later on, as you're going through the project and it's going through, depending on what the communication schedule is and how often you get updated on progress. I mean, one of the key things I'm going to be interested as an investor, are we ahead, or are we on time, or are we behind? Because, if we're running behind, then I'm wondering, is this deal going to succeed, or am I going to be getting that infamous cash call, where the sponsor calls you up and says, hey, we budgeted, $500,000 to carry us from we're ready to go until lease up, and we burned through 500,000 and we still got 3 months left to go, so we need extra amount of cash or the whole project's going to fail. So responsible management of cash, sources and uses of cash flows are all based on assumptions of what they think they can do. And all I'm saying is that a good operator is going to have based those assumptions either on past experience, deals they've actually done, or other deals that members of their team have done, or studies or research that has been done by third parties, local professionals, people who specialize in providing that kind of data, so that you can look at it and go, okay, this thing makes sense. It's got some basis in reality.
Absolutely. And I know we're running a little bit short on time, but I do want to bring up the importance of this slide. And I know that when you're looking at a deal and you see that famous, IRR calculation or target cash on cash return, it's really important to understand how much of it is cash flow and how much of it is equity payout at the end. So if even if you hear the word preferred rate of return might not even, sometimes people say, well, this is going to pay out a preferred rate of return of 8%. That doesn't necessarily mean you're going to get 8% in the first quarter. So it's really important to understand how much return you're getting in a distribution on a projected basis, and how much of that overall or that IRR is coming from the proceeds of the sale after the investment has concluded.
And preferred isn't guaranteed.
Which still isn't guaranteed. Which still
is not guaranteed.
None of this stuff is guaranteed.
Preferred. Yeah. Preferred means you eat first if there's something there. If there's nothing there, you don't eat. Guaranteed means, then there's a provision to make sure you get it no matter what happens, and those are harder to find.
Absolutely. So we like to break it down. This is just kind of an example. We like to break down, and you'll see the annual returns. We like to put down what the annual returns would be from a distribution perspective, from a projected perspective, versus the liquidity events. So we kind of put it into two columns, and we say, okay, if you invested 50K, these are the projected distributions, these are the projected liquidity events, and when we expect them to happen. So there's a good awareness of when things might happen.
Yeah, sometimes folks will squeeze in, they'll give you return of principal and call it return on investment, and it gooses the numbers. And I've seen that. So if you're not great with financial statements yet, a great way to learn is to have a CPA or somebody, an experienced investor that can look at the financials and walk you through to make sure that you do understand them, because it's easy to have your eyes gloss over when you look at all the calculations and you just fixate on the bottom line in bold print and go, that's what I'm buying. And that can be great for you later on, making a complaint to somebody saying, hey, you told me this is what it was going to do. But that really doesn't excuse you from not understanding how the math was done. It's probably the hardest part of being a professional investor, is really knowing how to look at financials and make sure that they make sense. But I'm sure most of you are quite sophisticated in whatever it is you do for your day job. And if you could learn how to do that, you can learn how to do this. All I'm suggesting is that it's important in the beginning to have somebody mentoring you in that, that isn't got a horse in the race, if you will, as far as the deal.
Sure.
And then to learn. And after a while, you'll learn how to look at it. You'll know what you're looking at on your own.
Absolutely. So we talked a little bit about, I know we're a little bit over on time, but this is just really important stuff. When you're looking at a project, Russ has great experience in this. We used to do condo development, condo conversions. We used to flip houses. And, we were doing it in luxury markets where we were relying on someone's ability to borrow funds and transact and buy our house. And if that couldn't happen, it would be a very, very difficult, numbers game to try to rent out the property or things like that. So I think as we tiptoe towards all this recession talk and, whether we're headed one or not, or wherever we think we are, that's another hour of a webinar, but that Russ has a lot of experience in. Just know that that your investment has multiple exit strategies and what they are, and talk to your operator about them. Russ, I know your experience probably runs the deepest on exit strategies and analyzing those and where we are in the market.
Yeah, all I'll say is this. Everybody has a preferred plan, a plan A. Okay, this is what we're going to do. To me, the mark of a decent operator is somebody who says, and if that doesn't go as scripted, here's plan B, and maybe even here's plan C. And so, if they don't have that, then they really, in my mind, haven't thought through all of the risks, especially the risks of things that are outside their control. You mentioned condo conversion. I did a failed condo conversion project once. It wasn't any fun. Here's what happened. We bought the apartment building. We went through the process of getting it ready to do the condo conversion, get it rezoned, get it all propped up, and put a lot of money into it. We went to go take it to market, and the credit markets completely seized up and nobody was making loans on those condos. In other words, we could not find any buyers because the credit markets of buyers were going to rely upon to get their loans disappeared. Well, we didn't have a plan B. In other words, we were hemorrhaging cash and we didn't have a plan B because the way we had capitalized that structure, the rents on that thing were not going to carry, and we did not have enough cash reserves. So that's where I learned personally the very painful lesson of not having a plan B. Just as a general rule of thumb, any real estate related investment, especially one that has debt involved or recurring expenses of any significance, a strong cash flow model, even though that may not be where the bulk of the gain is, even that may not be what plan A is, even that may not create the kind of return that you're signing up for, it means you live to fight another day if market conditions turn south unexpectedly. So we always say cash reserves preserves and cash flow controls. So adequate cash reserves. Somebody's got a pro forma that has no cash reserves, that's a short path to a cash call. And then somebody whose cash flow model never breaks even, and the whole exit strategy is to get out before they run out of cash reserves to feed the negative, that can be dangerous if the market's illiquid when you want to get out. So always look for a plan A, but a good operator should have at least a plan B and maybe even a plan C.
Absolutely, and I can't stress enough the cash reserves. I'm a passive investor in other operators' reserves, and I like seeing balance sheets because balance sheets will tell you what the cash reserves are. So even though you're getting a return, I mean, you may be skating on really thin ice. So if one capital improvement comes up, you're gone. Your distribution is gone, is wiped out. So I always encourage folks to look at what the operating reserves are for a particular project and make sure they're sized correctly for the deal that they're taking over. If it's a huge deal with a lot of improvements to do, then that should be commensurate with the operating reserve that you carry.
Yeah, and if
Great.
you're comparing one deal to another deal and you see one deal that has very low cash reserves and another deal that has high cash reserves, and the deal with high cash reserves has a lower pro forma ROI, that doesn't mean it's a worse deal. It means that the guy who had no cash reserves was going for illiquidity to try to goose his returns, but you're taking additional risk. And this is, again, this shows up in the financials if you know what you're looking for. It's not rocket science, but you do have to know what you're looking for.
Absolutely. And I did skip a couple of slides. We talked about the PPM quite a bit and the operating agreement. So I think we're going to just kind of go to this last slide. So when you're talking to your operator, I think I would ask them, what is their communication strategy for you? What is the plan for K1 distributions? Am I going to have to beg you all year for my K1 so I can finish my tax return? Or are you going to assure me that you have an accountant and a bookkeeping process in place that you're going to get them to be no later than March 31st? Member meeting minutes. Am I invited to member meetings? Because corporate formalities happen. So, as a passive investor, am I welcome to listen to the meetings, and how is that format done? How am I going to get paid? Distributions, are they quarterly? Are they monthly? Are they one time at the end? Does the operating agreement say that I have to give a distribution if cash is available, or do I not have to give distributions? So there's a lot of little things. And just a little thing we like to do, we like to print out the corporate docs after they've been all finalized and send them out to our investors. Not a requirement, just kind of a nicety to have. And I like the regular communication and project updates. I kind of glazed over that a little bit. But I'll steal the words that Russ taught me, which is you should be communicating to your investors frequently enough so that just when they're asking what's going on with the project, you send the communication. So, as an investor, you should, if you're wondering what's going on with a project, hopefully that doesn't sit on your mind for more than a day or two. And you should hear from your operator and they should tell you the full picture. Sometimes communications from some operators that I've invested with are pretty terrible because they create more questions and more concern than they answer. So it's kind of a fine art, but make sure that your operator is accessible throughout the course of the investment.
Yeah, that actually a Robert Helms quote, though I appreciate you giving me credit for it, but he's the one that talks about that. One thing that I do think is important, though, because when there are meetings, you have to understand, in exchange for being passive and not having it, having limited liability, you don't have a vote.
Right.
If you're involved in the decision making, you're responsible for bad decisions. So it doesn't mean you don't have a voice. So a operator may decide, hey, I'm interested in knowing what you think, but it's more of an advisory input than it is an actual vote. At the end of the day, the manager is going to be the one making the decisions, and so you're betting on their management experience. But it is good to have open communication. And then the flip side of it is, if you get a little bit too vociferous as an investor, especially if you are majoring in the minors or trying to micromanage somebody doing their job, you may not be invited back into the next deal. I'm just being candid with you, because sometimes those activist investors, if you will, it's not that people aren't interested in hearing what you have to say, but sometimes, people want to be able to do their job. And so just try to be honest with yourself about the kind of input you're giving and whether you're adding value or whether you're stirring up drama, because part of it, again, what I said earlier, as an investor, you're investing in a relationship, and it may not be that their communication style, their management style matches you, and that's okay. Doesn't make them bad, doesn't make you bad, just not a match. But do understand that if you've got somebody that's got a good track record, good deal flow, and has the potential to make you a lot of money, you're trying to curry their favor. you want to work in. It doesn't mean you give them a pass on bad behavior, but it does mean that you need to understand you want to help them be successful to the extent that you can by giving them good input and leaving them alone and letting them do their work when you don't need to be involved.
Absolutely. So at this point, Russ, thank you so much for your time and the webinar. We're going to open it up for questions. My contact information is on the screen for anybody who would like to get in touch regarding questions about this webinar. There is a handout on the webinar, so you can get a copy of the slides. This will be posted to the Spartan Investment Group YouTube channel, and you can view all of our webinars and recordings there. We also do some live property updates and tours as we go to see different properties in different markets. And we have some updates on just kind of things happening at Spartan in general. So questions, basically the way you ask a question, you can type in your question at the bottom, raise your hand, and we can answer any questions that you might have. Anything goes. Maybe anything that we didn't answer or didn't bring up. Hopefully there's been some good discussion today to help you be a more savvy investor above and beyond what you've may have already today. Maybe it's just we're trying to improve your decision-making, awareness, and ability to invest in projects. Let's see, any questions from the group?
Due diligence is boring, ladies and gentlemen, right? Nobody wants to do due diligence. But it's important. If you're going to be serious about your career as an investor and making good decisions, and obviously preaching to the choir because you have been involved in this webinar and you've hung in there through the whole time, even though we've gone over. So I applaud you for being here, and I hope that you're not overwhelmed with it. It's really not all that complicated. If it's a foreign language to you now, it's like anything else that you learn to do. You kind of get involved in it. The main thing is just don't put too much of your net worth into any one deal until you really understand what you're doing and who you're doing business with, and you start to begin to get comfortable with what you're doing. You learn by doing, and candidly, you learn by making mistakes. Not every investment goes as scripted. Sometimes you lose money. Now that's part of being a pro, right? You take your lumps. But every opportunity, every deal is an opportunity to learn. And if you will use it for that, then you will compress time frames and you will become much more skilled at your ability to know what you want, what you don't want, who you like to work with, who you don't want to work with, and how to recognize a pro from a poser and a real deal from, a pie in the sky pipe dream. And as you get better at that, you'll end up making those better investment decisions and producing better investment results for yourself and your family.
We did get a few questions, and
Great.
I always like to use the analogy for seeing syndications. Don't swing at the first pitch. Let a pitch go by. Let a deal go by. Always look at one or two before you make a decision is for sure. So the first question, I really like this one. Are background checks common? And do you do background checks on operators? And if you don't mind, Russ, I'll take the answer on this.
Sure.
I have a personal philosophy on this. To answer your question, yes, background checks, they're not common. They're probably done very infrequently, but they're very easy to do. Put the person's name in Google and see what shows up. See what podcasts they've been on. See what deals they've done. See if there's any violations or problems in their history. And before doing a deal with them, maybe ask them, hey, is there anything, I'm about to do a background check on you. Is there anything that you want me to be aware of before I do that? The other thing that I'd like to say is, and to Russ's point earlier, don't waste an operator's time if you're not serious. So get their deal, look at their project, decide that you want to move forward, and then maybe do the background check. You don't want to ask, because sometimes background checks often require personal information, home address, birth date, things like that. Don't do a background check on all these operators but not be interested in their deal. So if you're really serious, you've looked at the offering memorandum, you've done some of your own homework, you're ready to pull the trigger, yes, it could be a good idea. Russ, do you have anything to add to that?
No, I think that's great, and I think that's a great sequence, right? I mean, do it when you are interested in the deal, and the only thing that would prevent you from moving forward was if the person was a crook. And before you even go through the process of looking at the deal, you can quickly look them up. The way we do it, like, and again, on the radio show, we're vetting prospective sponsors of the show, people who we're going to promote to our audience. And so our standard of care is much lower than, say, it would be somebody who's actually investing, money, especially if you're investing other people's money. But we will check with the state attorney general's office. We will check with the Better Business Bureau. We will visit their website and see what we can find out. We will Google. We will visit a couple of active investor forums to see if there's any chatter we should know about. If it's somebody that's kind of active in the space, we're pretty well connected. We know people who are leaders and really active in different trade associations and different seminars and different investment groups. And we just ask around, is this person a good person or a bad person, to your knowledge? And, a lot of times that's the go, no go. So you could do that first. And then look at the deal, or you could look at the deal and then do that. And then if the final thing is, hey, right before I wire the money, I just want to get this one thing out of the way. To Ryan's point, anything I'm going to find that I need to know so we can not waste each other's time. And that's a great way to handle it.
Yeah, another great question that we had, that I'll go ahead and take. Um, do you have any books, conferences, workshop, or other video materials to study to be an exceptional pro investor? And I'll say for me personally, because I passively invest with other folks and then obviously put together syndications, I learned about syndication from the Secrets of Successful Syndication that is put on by the real estate guys. It's 2 times per year. It's one of the only conferences that I go to. I think it's in September and February. Is that right, Russ?
Yeah, typically we do it in the fall and in the spring or the winter, depending on when the Summit at Sea is. This year we're going to do it in it's March we've got one coming up September 27th, 28th in Dallas. Then we're going to do it again, I think, in March of 2020, and then again in September of 2020.
Yeah, that's my favorite conference because you get the syndication attorney, you get operators, you get the knowledge, and you get to understand a baseline overview of all of the syndication documents, and you get a nice workbook, and it's just a great conference. The other conference I like going to, the only other conference, I do a couple of trade shows for self-storage, not the best for being an investor, just great for being in the industry, but I like the best ever conference that's put on I think if it's the end of February every year, best ever conference. I think it's besteverconference.com.
It's Joe Fairless's deal, right?
Yeah, Joe Fairless's.
Yep.
I really like that conference. It's got a component for passive investors, operators, and I would say that often the people in the crowd are just as impressive or more impressive than the people on stage. So the networking in the after hours is phenomenal, and you learn a ton. And then, the Real Estate Guys Radio, I've been a listener since I think 2013 when I started this journey in real estate and started a real estate company. Great show, and there's other good the Passive Cash Flow podcast with Kevin Buff is also very good, and there's some other great podcasts to kind of get you started, and then they talk about good conferences that you can go to and books from there. So I wanted to get to some more questions. Wow, we have a lot of questions. At what point does an investor request upcoming deal docs, turnaround time for delivering these docs? So I think your question, Alicia, is at what point does an investor request upcoming deal docs? So usually what you request to do for any operator is get on their list. You get on their investor distribution, and then you start receiving docs. Sometimes that operator require you to go through a process, an interview, fill out an investor intake form or investor questionnaire, and get you pre-qualified so that they meet the SEC requirements so that you can receive upcoming deal docs. I hope that answers your question. Another question, in the capital stack, how can similar investors get involved on the GP side of the deal when an operator may not have a cash to fulfill the GP side? Is this a bad idea? So I can talk to personal experience on this. I'm a small investor on a deal gone bad, and I'm an experienced operator, and I have a lot to add. So honestly, it's kind of to Russ's point, be really smart and calculating and specific about what you want to get involved in and how much noise you want to make. But if the deal is going really bad, at that point, I go into capital preservation mode. I go into how can I get my money out of the deal and not lose money, right? The number one thing. Being controversial, adversarial, unhelpful may not be the best way to go, but sometimes the operator will work with you on taking your advice and getting in there. But I mean, that's probably the best. Unless Russ, you have anything to add to that?
Yeah, I mean, no. Whenever you're in a situation, the first thing you have to do is look at your operating agreement and figure out what the sponsor's responsibilities are and what their rights are, if you will. And you have to look at what yours are and what it's reasonable for you to demand and how much voice you're allowed to have. Hopefully you have a good relationship and you can pick up the phone and have a conversation. You know, it's nobody wants to have that conversation. Nobody wants a deal to go sideways. If you think you've got some expertise or skill to bring to the party and you can help save it, then you know you don't necessarily have to become a partner. You could become a consultant. That would continue to limit your liability, but allow you to have a voice. So there's ways to structure your involvement if you think you can bring something to the party, or maybe you know people, say, hey, look, I can see you're struggling with this thing. We all have a lot at stake here. I know people who can help. I do agree with Ryan's comment, though, that if you turn it adversarial, that shuts down all conversation. The operator's got to go into a defensive posture, get lawyers involved. It sucks all the remaining money out of the deal. It only makes things worse. The only reason you would want to do that is if you were just absolutely convinced that this person you're dealing with is an abject criminal. Because otherwise you're better off trying to work with them and help them. If they're not, you know, if the problem isn't existing because they did it on purpose or they're trying to hurt you, then they want it fixed too. And if you can legitimately help, they should be part of that. The minute it goes adversarial, everything just breaks down and the whole focus becomes on everybody's in every man for yourself. It becomes self-preservation mode. It's just very unhealthy.
Great. Yeah, no, and that's a great point. And I wanted to get to Ben's question because he asked it a little earlier on. Does Spartan raise capital for individual deals or discretionary funds? How can we get involved in either? So this applies to kind of any operator. That's a great question. Understanding, we do it deal by deal specific. So if we identify a specific self-storage property in a specific market, we set up a single purpose LLC for the purpose of investing in that specific deal. Some operators do it differently. Sometimes they do a fund of funds or a fund that it has a specific asset class focus or a certain niche, and they target return, and you don't really know what the fund is going to buy, but you know the types of things that it's buying. To get involved in anybody's operating deals is to get on their investor list and make sure that you're part of their investor distribution, and again, you get qualified to receive some of the deals. We require a pre-existing relationship with everybody, which is a phone call and an investor form. So once we have that done and out of the way, then we can check that box. What is the average net income or net worth for non-accredited investors that typically syndicators like to see? So there is no requirement for non-accredited investors to have a certain net worth or liquidity. It really depends on your sophistication. The SEC says accredited or sophisticated investors. And the investor's ability to reasonably assess the deal. So we have a lot of conversations with our investors before we let anybody see any of our projects, just to make sure we understand their experience and their risk tolerance. And sometimes we just turn people away and say, infrequently, but we say, hey, maybe just learn a little bit about the space and get some more education and come back when, you've kind of understood some of the risks. But I wouldn't say it's really defined. Russ, do you have anything to add to that?
Yeah, well, I agree. First of all, yes, it's sophistication very important. I think if I understood the question correctly, it was kind of like, hey, what's the net worth requirement? You kind of back into it. So let's say, for example, someone's doing a raise and their minimum investment is $50,000 and your total liquid net worth is $50,000. I'm not going to take you. I'm not going
No.
to take 100% of your liquid net worth. So in that case, I might say, okay, you need to have at least $200,000 liquid. You may not be accredited, but you got 200,000 liquid, and you can put 25%. Now, there is no rule about that. Somebody might say, well, that's too much. I wouldn't take that. Somebody else might say, well, I would take 50%. But nobody should ever be taking 100%.
Correct.
So, and I'm going to ask you that question. I want to know, can you afford to lose this money? We're not planning on losing the money. I wouldn't be offering you the deal. I'm not in the business to lose money, but I also don't want to, ruin somebody's life if a deal goes bad because of things that are completely out of my control. So you're going to back into it. So be prepared when someone is when you're going to look at a deal. If you're a non-accredited, or even if you're an accredited investor, be prepared to answer the question about how much the investment or proposed investment represents in terms of your total net worth and your liquid net worth. And understand that you're going to have a liquid net worth and a total net worth that is a multiple of whatever the deal size is, or the person shouldn't be taking you. And if they are willing to take you, that's a red flag.
It is, the deal sponsor is gonna know what you have when you fill out your purchaser questionnaire. So if you raise your hand and say, I want to do the deal, the first step in the process is to fill out a purchaser questionnaire, and net worth and liquidity is required on that, at least for ours, and I think most syndications. So we're gonna look at that and we're gonna say, looks like I'm taking your last dollar, and I don't want you calling me in a month because you can't pay your bills or you can't do your groceries, and now I'm doing a return of capital, or worse, I'm saying, sorry, it's kind of too late, which is really what the rules say. I mean, this is an illiquid investment. And I think that's one of the potential downsides to real estate syndications is that it is not liquid. You cannot push a button, make a trade. There is no securities market that exists for these types of investments where you can just trade and things like that. So it's really important to know that before you go into these projects.
The flip side of that, though, is it's very private and fairly
Yes.
stable depending on the underlying deal. I mean, this thing is it's not out there. I mean, if you have creditors or anything like that, and private placements are private, so they're nice.
Exactly. So last question we're going to have tonight. I'm looking to create my own portfolio. Should I start as a passive investor? I'll tell you what I did. So I started active with my own money. And not everybody has that opportunity, but I saved money from my corporate job. And with my business partner, we pooled our money together and we started doing deals. And that's how we started the company. Now, if you don't have money to do deals, it doesn't mean you can't do deals. I'll tell you how we really learned the self-storage business, and that was investing with another operator. That really helped us understand this whole process and how it works. And really, I mean, to go back to the secrets of successful syndication, Scott and I were flipping houses. We flew down to Dallas. I think it was in March of 15 or 16. I can't remember exactly. And we went to the conference and we learned about this syndication world. And then we realized, oh, that's what that person does and that person does and that person does. And so we reached out to them and we said, hey, do you have any deals that you are looking to syndicate or need capital for? And we both invested. And that was our kind of front row to a syndication. And we got to see the whole process through, how they put together the deals, the numbers, the financing, all the deal documents, everything like that. And then we said, hey, we can do this. And sometimes we have investors that are looking to be operators and they're in our masterminds or in our groups, and they realize after a while, I'm not cut out for this. I just want to be passive. And they decide that they just want to be passive. So kind of figure out, put your toe in the water, see what you want to do, maybe invest with an operator, see how it goes, and decide what your personal investment philosophy is, like Russ was saying in the beginning. What What are you really all about? What is your why? And understand what that is before deciding if going passive or active is right for you.
Yeah, actually, this is one of my topics at the Secrets of Successful Syndication when I kind of explain, what hat are you going to wear and how do you get started. Think of being a passive investor in somebody else's deal as an apprenticeship. And sometimes you can say, hey, Ryan, I'd love to make an investment. I'll put $50,000 in your deal, but I have a favor to ask. Would you mind if when you go on a due diligence deal, I come with you when you're evaluating deals, if I could help you do some of the research or underwriting, because what you're doing is you're looking for the opportunity to learn. And if you think about what people pay for a college education, which is worth whatever it's worth in today's marketplace, I don't know. But for that same amount of money, you could probably turn over, maybe a $50,000 investment, get it back from a deal and put it in another deal and apprentice with 2 or 3 different people, 2 or 3 different niches. So if you don't feel like you're competent to run a deal as a sponsor, but you want to learn a niche, then take the money that you have and invest it. If you say, well, I don't have enough money to invest, then maybe go get a trusted friend, a family member, and create a little, partnership where you're the hustle and they're some of the money and you're some of the money, and then you guys are going to invest passively and learn the business that way. So there's ways to get it done. If you feel like, hey, I've been investing in my own account for a while, I've got a track record, I think that it's fairly leverageable, I'm going to stay in my lane, I've been doing houses, so I'm going to go start my first syndication doing houses, or I've got this other thing I'm going to go do and the skills that I developed in houses translate, or I'm going to bring somebody else on board. So I have basic investing knowledge, but I'm going to bring in a product niche expert to help me do mobile homes or self-storage or whatever it is. So think of it like college. And the idea is when you're sitting there at the front end of college, you kind of have your GE, which is kind of the stuff we're talking about today. And then there's the stuff that's your elective stuff that's really going to help you earn your degree. And you've got to chart your course. You got to figure out, how am I going to put together the experiences and the knowledge and the relationships to get good and be positioned to really be in this business. If you approach it that way and use your money strategically, not just to get a return on investment, but also to get an education and build relationships and build a track record, then you can really compress timeframes on how quickly you can build a brand that people will trust, and you can look somebody in the eye with good integrity and say, yes, I know what I'm doing, and I feel like I have the capability, the commitment, the competency, and the integrity to take your money and put it to work and bring it back home with a profit.
Yeah, and the last thing I'll add tonight, because I know that we went a little bit long, but it was all really good quality stuff, so I just wanted to keep it going, is we actually had an investor, and he might be on the webinar tonight, that invested with us over the last couple of years, and he decided that he wanted to come do an internship with us at our corporate headquarters here in Golden, Colorado, and he came this summer and underwrote deals all summer long to learn how to do this, and he added a ton of value to us. And he's actually attending the University of Michigan Ross School of Business and the MBA program in real estate. And he's getting the real world education, real world experience, and he's passively invested. And it was just a great example of how, he was passive, but now he's looking, now he knows how to underwrite. And, as an intern, we ask you to add value to us first. But you also get a tremendous amount of value in our internships. So check us out, Spartan-investors.com, if you have any interest in internships or incoming job opportunities that we might have. But with that, I want to thank everybody for coming out tonight. Thank you, Russ, for your time and your wisdom. You added a ton of value to our webinar tonight. And we'll see you hopefully in Dallas upcoming soon.
Thanks, everybody.
Thanks, everybody. Have a great night.